Hi, I'm Michael Yardney, and over the 40 years I've been investing in real estate, I've seen many investment fads and fashions. I've seen them come and go. Recently, I've noticed in the current, more mature stage of this property cycle, as investing in capital city properties becomes more unaffordable, more investors are once again looking for new investment fads. And I've noticed others feel they've missed out on the boom conditions over the last couple of years, and they seem to be in a hurry to make up lost ground. Many are influenced by the latest get-rich-quick artists. They've got great stories that how you can join them and you can become stupendously wealthy. Now, I know sometimes their stories can become very compelling, sometimes hard to resist. They often pander to people's wishes. People want to give up their day jobs and become involved in property full-time. But in reality, most investors take many years to accumulate sufficient assets to do this. You see, patience is an investment virtue, and as Warren Buffett rightly said, wealth is the transfer of money from the impatient to the patient. Now, there's nothing new about this. I remember way back in the late 1970s, there was a fad into timeshare apartments. They sounded a really good idea at the time, but it was really just a way of developers getting rid of stock they couldn't sell. Then in the late 80s, there was a fad buying off the plan. At that time, it was in the Gold Coast. There was a Gold Coast property boom. However, many investors lost their shirt as the Gold Coast property market languished for most of the 1990s. Then in the late 1990s, the fad was buying off the plan again. It came back to a whole new unsuspecting generation, but this time with a twist. While some investors who bought early made a profit during that boom, many ended up ruining the day they bought their off-the-plan high-rise city apartments because they never intended to settle on these properties. Instead, they hoped to on-sell them, to flip them on to other people, to other gullible property investors before completion. This created a succession of investors playing musical chairs, buying the same property off each other. But when the music stopped and the property cycle suddenly ended, the last man sitting or standing was left with an overpriced property that he didn't really want or couldn't afford. Then in the 2000s came seminars promoting investment in New Zealand real estate, followed by the push to buy cheap properties in depressed regional locations around Australia and then to renovate them. Actually, I recently found an old article I wrote about 10 years ago telling the story of investors who bought in small regional towns and lost out due to the lack of capital growth, to higher vacancy rates and to expensive holding costs. Even worse, some were lured into selling their existing investment properties, which would have since doubled in value. They were lured to chase high returns elsewhere. Then over the last decade, there have been 3 waves of investors enticed to invest in the United States, with promises of properties cheaper than the price of a second-hand car back here. The internet is littered with stories of casualties of this fad, as it is of investors who've invested in the latest hotspotting in mining towns, in regional towns over the last 5 years too. On the other hand, while all this was going on, a small group of investors, those who bought the right properties, slowly but surely grew their wealth. It's no coincidence that these smart investors followed a system to take the emotion out of their decisions and to ensure they didn't speculate or get sidetracked by the latest fad. This may be boring, but it's profitable. Let's be honest, almost anyone can make money during a property boom because the market covers up most mistakes. But many investors without a system find themselves in financial trouble when the market turns. Warren Buffett said it succinctly, a rising tide lifts all ships, and you only find out who's swimming naked when the tide goes out. So what makes the right property investment? Well, one thing's for certain, there's no such thing as a perfect investment. In fact, if somebody tells you they found the perfect investment, be very skeptical and ask lots of questions, because chances are they're trying to sell you something. Maybe something you shouldn't be buying. In my view, we're going to have some challenging economic times ahead, so you should only invest in assets that are both powerful and stable. By powerful, I mean they must have the ability to grow at high wealth-producing rates of return. By stable, I'm looking for investments that grow in value steadily and surely without the major fluctuations in value that some regional markets, smaller markets and shares have. Many investment vehicles are powerful and many are stable, but only a few are both. In my mind, prime capital city residential real estate is one of the investment vehicles that have both power and stability in spades. If you prefer to have consistent profits and reduced risk, avoid the fads and follow a proven system. Now, that's going to make your investment boring, but it's sure going to make the rest of your life exciting. If you want to understand where these investments are and how to take care of them and take advantage of them and not walk into the mind trap that's ahead for many investors, why not give a call to the team at Metropole and have a chat, have a free property investment strategy session. If you're a beginner, we'd love to catch up with you and explain what's ahead, what you could do, how you could avoid the trips and traps of beginning investors. If you've already got a portfolio, we'd love to see you and see how your portfolio is going, do a strategic portfolio review and talk to you about the next steps.